Okay, let's unpack this. Hims and hers, ticker Hims, they've certainly made some serious waves, started out tackling those pretty uncomfortable health topics, right? And now their big aim is to be, well, the Amazon of healthcare. But like we always see with these really ambitious companies, this kind of growth, it definitely comes with its own fascinating complexities and some pretty significant challenges.
Indeed. Yeah, for this deep dive, we've really gone through a comprehensive set of financial reports, operational analyses. What we're looking at is this direct-to-consumer telehealth platform, experiencing just explosive growth. But at the same time, they're navigating some really turbulent regulatory and legal waters. So our mission today really is to pull out the most important insights, surprising facts from all these sources, give you, the listener, a shortcut to really understanding the full picture with Hims and hers. We're talking strategic vision, those impressive numbers, and the big risks that are playing out right now.
So where did this all kick off? Hims and Hers, founded back in September 2016 by Andrew Dudum, and they really carved out their niche in telehealth by, well, jumping straight into those areas people don't always talk about easily, like sexual health and hair loss.
Yeah, that was a particularly smart initial move, I think. They saw these significant unmet needs and offered solutions that were, discreet and accessible.
And here's where it gets really interesting. They absolutely haven't stopped there. They've rapidly broadened their services way beyond those first niches, now tackling, high-demand chronic conditions. We're talking weight loss, mental health, even personalized skincare. Their strategic ambition, it's incredibly bold. They want to be the default interface for preventative, personalized care.
Right. And the core of how they operate, it's this recurring subscription model. You can almost think of it like Netflix for healthcare. Maybe. It's really designed to keep people engaged long-term and, of course, for consistent monetization. Their value proposition is pretty clear. Discreet, personalized, accessible care. Basically removing a lot of the hurdles you find in, conventional healthcare.
That makes sense. It's a strong pitch. Can you walk us through some of the key product areas they've built out now?
Sure. So beyond their original sexual health stuff, ED, premature ejaculation, delivering generics like sildenafil, tadalafil, all very discreetly they've expanded quite a bit. Their hair loss vertical that offers treatments like finasteride, minoxidil, often in these subscription bundles. Then mental health, recognizing that huge surge in demand, they offer virtual access to therapy, prescriptions for anxiety, depression, sleep issues, all virtual. And a really major growth driver recently has been weight loss. This is where they provide access to those popular GLP-1 meds like Ozempic, Wegovy, Mounjaro, Zepbound, plus generics like liraglutide, metformin, bupropion, and coaching too. And lastly, skincare. Personalized treatments for acne, anti-aging, all based on, online assessments.
And it sounds like they're not stopping there. I know they've got upcoming launches, testosterone therapy, menopause support, both planned for 2025. What about longer term?
Yeah, their longer-term vision goes even further into longevity, sleep management, just broader preventative medicine. They genuinely seem to believe they can serve over 100 million U.S. consumers. They point out that maybe up to 90% of people who could use their services in key categories aren't even seeking treatment yet. It's this huge, largely untapped market they're going after. And the strategic pillars are really designed specifically to capture that.
Okay, so what are those pillars? How are they planning to tackle such a, well, massive opportunity?
It really comes down to a few key things. First is vertical integration. They own and operate their own specialized compounding pharmacies. These are called 503A and 503B facilities. Yeah. They can create custom mixed medications there. And importantly, back in February 2025, they acquired a U.S.-based peptide manufacturing facility. So this whole vertical integration play, it's about controlling the production of injectable therapies for these newer categories. The core idea, as they put it, is gaining cost and availability advantages, allowing for faster iteration, better quality control, and long-term scale. They're bringing crucial parts of the supply chain in-house.
That seems really smart strategically, especially for a company that relies so much on specific compounds' personalized formulas.
Exactly. Their second pillar is tech-driven personalization. They use AI quite heavily, like their MedMatch tool, to tailor treatments. Over 60% of subscribers get these personalized plans, and that number jumps to over 80% in dermatology. And they say this directly correlates with higher engagement, better retention. So personalization isn't just, a nice feature, it's a powerful business driver. Then you have their global ambitions. They recently bought Zava, which is a big digital health platform in Europe, and they're planning to expand into Canada in 2026. Now, this timing is really interesting. It's strategically set to coincide with what they anticipate will be the first ever availability of generic semaglutide globally. positioning them for affordable weight loss care up there.
Huh, that's sharp, getting ahead of a major market shift like that.
And finally, their marketing and customer acquisition approach. It's very multi-channel, direct-to-consumer. Big brand campaigns, influencer partnerships. They even did Super Bowl ads. They also do some collaborations with health systems. But for a subscription model like theirs, retention is absolutely key. They try to foster that through a strong user experience, continuous service delivery, always adding value to keep people subscribed.
All right, so with such a bold vision, this aggressive expansion, the big question is, are they actually delivering on the numbers? Let's peel back the layers on their financials. Because, wow, some of these figures are really striking. For the full year 2024, Hims & Hers brought in nearly $1.5 billion in revenue. That's up a huge 69% year over year. And even if you take out the GLP-1s, revenue still grew a very strong 43% to over $1.2 billion, which actually met their old 2025 target a whole year early. Then Q1 2025, revenue surged, 111% year over year to $586 million. Blew past analyst estimates. Their online revenue, which is like 98% of their total sales, jumped 115%. Subscribers hit 2.4 million in Q1 25. That's up 38% year over year. But for you, the listener, what really stands out here, I think, is the monthly online revenue per subscriber.
Yeah.
It rose to $84 in Q1 2025. That's a 53% increase from 2024. Really shows they're getting more money from each user.
Yeah, and if we connect those really impressive top-line numbers to profitability, the story gets even more interesting. They've made a massive shift. In 2024, they reported $126 million in net income. It's a huge turnaround from a net loss in 2023. Adjusted EBITDA hit $176.9 million in 2024, and that it basically tripled to $91.1 million in just Q1 2025. Margins expanded to 16%. EPS for Q1 2025 was $0.22, a significant jump. Now, it is important to note their gross margin did dip slightly, went from about 83% in Q4 2023 down to 77% in Q4 2024. And this isn't just random. It kind of reveals a critical strategic tension, maybe. Hims & Hers built its brand on affordable generics, or accessible stuff. Now, as they pivot more towards branded drugs, especially in weight loss, they're moving into a higher cost game, and that naturally puts pressure on those margins.
Right, that makes sense. So beyond just profit, what about their financial flexibility? Are they building up a strong cash position?
Oh, absolutely. They've shown really robust free cash flow generation, $198.3 million in 2024. And their balance sheet looks remarkably strong. They're essentially debt-free, at least in terms of interest-bearing debt. And they were holding over $322 million in cash and short-term investments as of March 2025. Their return metrics, like return on assets at 18.54% and return on capital at 26.94%, they really demonstrate an efficient use of their money.
That's incredibly solid. But okay, the critical question then becomes, how does the market actually value this kind of performance, especially with that kind of growth trajectory?
Yeah, that's a key point. Their current price to earnings, or PE ratio, it's quite high. It's around 76. Now, for those less familiar, that basically means investors are willing to pay 76 times the company's current annual earnings per share, which signals, huge confidence in future growth. They're paying a premium for what they expect, not just what's happening now. Their price to sales, or PS ratio, is about 5.7x based on their 2025 revenue guidance. But, and this is interesting, if they actually hit that ambitious 2030 target of $6.5 billion in revenue, today's market cap implies a much lower PS of just 2.1x, which is just, significant upside if they really execute perfectly. Some discounted cash flow, DCF analysis, estimate their fair value around $60.24. That's actually close to their current share price, which is about $51.31. But it's notably higher than the average analyst target, which is around $34.38. And look, the stock's year-to-date return is 148%. Its beta is 3.24. That just screams high volatility. For context, that beta means it tends to swing about 3 times more dramatically than the overall market.
What's kind of fascinating for investors, though, is that historically, buying Hims after they beat earnings expectations and holding for 30 days, that yielded a 42.54% average annual return. Interesting pattern there.
Okay, so we have this, frankly, impressive growth story. But no growth story is, well, without its shadows. And for Hims & Hers, those shadows are cast by some very real regulatory and legal thunderstorms that could seriously impact everything we've just talked about. The primary concern, and it's a big one, is their involvement with these compounded GLP-1 medications, which brings us to a pretty seismic shift. The U.S. FDA officially took semaglutide off its national shortage list on May 22, 2025. And that move effectively prohibits compounding pharmacies from making compounded semaglutide injections, except in very rare cases.
Yeah, and what's particularly striking is just how fast this whole situation escalated. Hims & Hers had already been facing accusations, right? Violating federal regulations by allegedly using unapproved raw ingredients, APIs from China, and also engaging in bulk sales of compounded semaglutide. And remember, this compounded semaglutide made up 15% of their 2024 revenue. So this is not a minor part of their business at all. Then, just a month after the FDA announcement, on June 23, 2025, Novo Nordisk, the maker of Wegovy, publicly terminated its collaboration with HIMS and HERS. They cited concerns about illegal mass compounding and deceptive marketing practices. Pretty strong language.
Wow. Okay, so given those pretty dramatic developments, what does this all mean for the company's immediate future? Like, right now?
Well, it immediately translated into legal liabilities. Two class action lawsuits, Suktio v. HIMS and HERS and Yaxidian v. HIMS and HERS, were filed literally that same month, June 2025. These lawsuits, they accuse the company of securities fraud. They allege HIMS and HERS misled investors about how stable their partnership with Novo Nordisk really was and about their compliance with FDA rules. Some estimates even suggest that a potential $100 million settlement, if it came to that, could wipe out about 13% of their current market cap.
And how does this particular issue fit into the maybe broader regulatory picture for telehealth in general?
Well, it raises an important question about the overall environment, doesn't it?
Yeah.
While the FDA hasn't taken formal action specifically against HIMS and HERS yet, their rules are pretty unambiguous. Mass production of compounded drugs like this is generally prohibited. And beyond just the GLP-1 issue, the whole telehealth industry is facing this ongoing regulatory uncertainty. We're seeing what's described as a patchwork of state regulations, plus these temporary extensions of key Medicare telehealth rules. It just highlights instability and a lack of clear, predictable federal policy for the industry. Makes it really challenging for any telehealth company to plan long-term.
Right. And beyond those immediate legal fires, HIMS and HERS operates in an increasingly crowded market, doesn't it? The digital health space is getting pretty saturated.
Oh, absolutely. You've got major players like Amazon's One Medical, Cigna, CVS Health, all actively expanding their digital offerings. And they have vast resources, huge existing customer bases. So what stands out as a potential challenge is that HIMS and HERS' historical price advantage, being the affordable option, that might be eroding as competition heats up,
Yeah.
especially in that GLP-1 market where generics and biosimilars are expected eventually, which will likely drive prices down even further. It forces them to constantly innovate just to maintain their edge.
And what about their internal operations and, governance in the face of all these pressures?
Yeah, let's connect it back to their operational challenges and oversight. We mentioned that gross margin decline earlier, 83% down to 77%. That's partly due to that strategic shift towards higher-cost branded drugs. Scaling challenges are also significant. Maintaining quality control, ensuring you're compliant with regulations across all these different states and potentially countries, managing the rapidly growing infrastructure, 700,000 square feet of fulfillment and lab space already. I mean, these are massive undertakings. They require exceptional operational discipline.
Sounds like a lot to juggle, for sure. What about the people running the show, the leadership and the board oversight?
Well, the executive leadership team, on paper, looks strong. Diverse backgrounds. Andrew Dudum, the CEO, he's a serial founder. Melissa Baird, the COO, has deep experience in direct-to-consumer operations and scientific research. Solil Bhatten, the chief legal officer, brings nearly 2 decades of healthcare law experience, which is obviously crucial right now. Yemi Okupe, the CFO, comes with financial leadership experience from other high-growth consumer tech companies like Uber and Google. And Dr. Pat Carroll, the chief medical officer, was formerly the CMO at Walgreens, so real healthcare chops there. Their board of directors also includes some pretty seasoned medical and business leaders like Dr. Toby Cosgrove, who used to be CEO of the Cleveland Clinic.
That is an impressive lineup, which kind of begs the question, how are these recent issues, especially the legal ones, impacting their governance, even with such a strong team apparently in place?
That's a critical point to think about, because despite having this formal corporate governance framework, publicly available documents and all that, those recent securities class action lawsuits, they also specifically allege abusive corporate governance practices and breaches of fiduciary duty. And these allegations are directly linked to the GLP-1 controversy. So the outcome of these legal fights will be really critical, not just financially, but for their reputation and investor trust. It really tests how external pressures can challenge even seemingly robust internal structures.
Okay, so we've gone really deep into HIMS itself. Let's maybe zoom out for just a moment and look at the bigger picture. The whole telehealth industry they're operating in. I mean, the industry itself seems to be booming, driven by several factors, right?
Oh, indeed. Yeah, it's definitely fueled by that rising demand for GLP-1s we talked about, but also growing consumer demand generally for personalized care and just this overall acceleration towards digital health care. What's fascinating here, I think, is how technology is both a massive driver and also a challenge. You have AI-powered diagnostics and personalization, like HIMS and Hers MedMatch tool that's key, leading to better efficiency, more engagement. Generative AI is also rapidly cutting down administrative burdens for clinicians, letting them focus more on actually caring for patients. But of course, this whole digital transformation just highlights the critical need for really robust cybersecurity measures to protect all that sensitive patient data. That's a constant worry in healthcare.
And finally, what about the advertising, the marketing that brings these direct-to-consumer companies to our attention? That seems to be growing rapidly too.
It is. Direct-to-consumer, or DTC, healthcare marketing is booming, definitely shifting towards digital channels and AI-driven targeting. But this raises an important question. How do regulations play into that, especially as they try to market globally? Well, increasing regulatory scrutiny is a big factor. For instance, the US FDA's major statement rule from 2023, it requires really clear risk disclosures in ads. It even has strict formatting rules that could lead to enforcement actions, especially on digital platforms where space is limited. And then you look at the EU, for example, they have even stricter bans on advertising prescription drugs directly to the public. So companies like Hims and Hers, they have to navigate these very different rule books across the globe. That can significantly increase costs and compliance burdens, making global expansion quite complex.
Wow. Okay, we have truly taken a deep dive into Hims and Hers today. From its really ambitious vision and those impressive financial gains right into the heart of its most pressing challenges.
Yeah, this high growth, high risk scenario, it's genuinely fascinating to watch unfold. The company clearly has the fundamentals in place, strong subscriber growth, good retention numbers that shift to profitability, a seemingly scalable business model. They have the pieces to potentially achieve those ambitious long-term targets. However, their ability to successfully navigate these regulatory and legal storms, particularly around GLP-1 compounding, that feels absolutely paramount to their future right now.
So for you, the listener, here are maybe the key factors to keep a close eye on as this story develops. First, the FDA compounding ruling and enforcement. What definitive stance and, crucially, what actions will the FDA actually take regarding Hims and Hers compounding practices? That's huge. Second, the litigation outcomes. How will those class action lawsuits resolve? What will be the financial hit and the reputational damage? Third, competitive positioning. Can they truly hold on to their market share and keep differentiating themselves in what's becoming a very crowded space? And finally, diversification beyond GLP-1s. How successfully can they scale up their other verticals? Mental health, skincare, those new launches like testosterone and menopause support. Can they reduce their reliance on the weight loss category?
Yeah, until we get much greater clarity on those fronts, Hims and Hers really remains what you'd call a speculative growth investment. Its long-term potential truly hinges on their execution against these really formidable headwinds.
So what does this all mean for the future of personalized preventative care and how it gets delivered to us? We'll definitely be watching closely to see if Hims and Hers can actually become the Amazon of healthcare while successfully navigating these incredibly complex regulatory waters. What stands out to you, the listener, as maybe the biggest hurdle or perhaps the biggest opportunity for Hims and Hers moving forward? Something to think about.